Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in your favorite companies' financial reports. And let me tell you, this latest filing from BNY Mellon, California, AMT-FREE Municipal Bond Fund is a bit of a mixed bag, but it does give us a really clear picture of what's going on in the world of municipal bonds. So what are we looking at here? This is basically an annual report for shareholders of a specific fund, a fund that invests in municipal bonds that are free from federal and California state income taxes. Think of it as a yearly checkup on how your investment in this specific fund is doing. This report covers the period from June 2024 to May 2025. Now, the fund has several different share classes, Class A, Class C, Class I, Class Y, and Class C, each with slightly different costs and benefits. For example, Class A shares returned 0.86% over the last year. Now that's interesting because the benchmark index, they compare themselves to the Bloomberg US Municipal Bond Index actually did better, returning 2.03%. So right off the bat, we see that the fund didn't quite keep up with the overall market. The big reason the report gives for this underperformance is that the municipal bond market overall was pretty flat. They mention a significant supply of new bonds, which acted like a drag on prices. Now, on the flip side, the fund actually benefited from holding a lot of BBB-rated securities, which are generally considered a bit riskier but offer higher yields. However, this also hurt them because they were heavily invested in California-specific things like revenue bonds from hospitals and colleges, which didn't perform as well as the rest of the market. So more exposure to California and certain types of bonds meant they really felt it when those specific things like revenue bonds from hospitals and colleges, which didn't perform as well as the rest of the market. So more exposure to California and certain types of bonds meant they really felt it when those specific things like revenue bonds from hospitals and colleges, which didn't perform as well as the rest of the market. So more fee rated securities, which are generally considered a bit riskier but offer higher yields. However, this also hurt them but performed. Let's quickly look at some key numbers. The fund itself is quite sizable with $527 million in assets under management. The portfolio turnover rate is about 12.39%, which means they bought and sold about percentage of their holdings over the year. This is a pretty moderate turnover rate for a bond fund. Now moving on to Class C shares, these generally have higher fees, and for the year ended May 2025, they returned a rather dismal 0.08%, which is even lower than Class A and significantly underperformed the index. Here too, the reasoning is similar: a flat market and overexposure to underperforming California sectors. Class A shares, on the other hand, did a bit better, returning 1.1%. These shares typically have lower expenses because they are sold to institutional investors. They still underperformed the index but were closer to keeping pace than the Class A and Class C shares. Class Y shares returned 1.17%. These are usually for very large institutional investors and also have very low expenses. They were also slightly behind the index. And finally, Class C shares returned 1.07%. These are also designed for specific types of investors and tend to have lower fees as well. Again, they trailed the index. It seems the overall strategy of being heavily exposed to California and certain revenue bonds impacted all share classes to some degree, although the lower cost classes held up slightly better. Now let's quickly touch on the costs associated with managing this fund. The report details the fees paid to the principal accounting firm. For the year 2025, the audit fees were around $38,419 and audit-related fees were about $14,322, and tax services were $3,342. These are standard operational costs for a fund of this size. Let's dive deep into the actual investments themselves. This is where we can see exactly where the money is. As of May 31, 2025, the fund held total investments valued at over $525. The fund held total investments valued at over $529 million. A huge chunk of this, almost 96.3%, is actually invested in California-specific municipal securities. This is a massive concentration and explains a lot about the fund's performance relative to the broader US municipal bond market. Within California, they hold a wide variety of bonds, including general obligation bonds and revenue bonds from many different entities like the California Housing Finance Agency, Allendale Corridor Transportation Authority, and numerous school districts and health facilities. Look at this one, Escondido Union High School District Zero Coupon Go Bonds. These are insured by Assured Guaranty Municipal Corp, and as of May 2025, they were valued at just over $1 million. Here's another example: Foothill Eastern Transportation Corridor Agency revenue bonds, again insured and with a zero coupon. And take this offering from the California Municipal Finance Authority for the Palmdale Aerospace Academy project. These were offered to qualified institutional buyers. This security from Peralta Community College District is interesting because it's been pre-refunded. That means new bonds have been issued to pay off the old ones, and these are backed by US government securities. After all expenses and everything, the fund's net assets stood at about $527 million. That's down from the previous year, which had net assets of over $580 million. This drop clearly reflects the fund's struggles to keep pace with the benchmark index and the overall market conditions. Looking closer at the financial highlights, we can see the total return for Class A shares was 0.86%. This is exclusive of sales charges. The ratio of total expenses to average net assets for Class A was 0.86%. For Class C shares, the total return was even lower at 0.8%, and their total expense ratio was much higher at 1.65%, which makes sense given their fee structure. Class I shares showed a total return of 1.10% with a much more appealing expense ratio of 0.63%. And Class C shares returned one index highlights this concentration with an expense ratio of 0.67%, TAPNet. So what's my take on this filing? Well, the fund is heavily concentrated in California municipal bonds, which is a double-edged sword. When California's economy and its municipal projects boom, it can lead to great returns. But when those specific sectors or bonds underperform as economy and its municipal projects boom, it can lead to great returns. But when those specific sectors or bonds underperform, as they did in the last year, the fund really takes a hit. The fact that the fund consistently lagged behind its benchmark index, the US Municipal Bond Index, highlights this concentration risk. While the fund's objective is to provide tax-exempt income specific to California investors, this heavy reliance on one state sector really amplifies the risks. The lower expense classes like I and Y performed better relatively because their lower fees meant less of a hit from the overall market's slow performance. The story here is about concentration. The fund's strategy of focusing solely on California municipal bonds makes it very susceptible to the state's economic fortunes and the specific performance of its municipal issuers. While this can be a strength in good times, it's a definite weakness when those specific segments of the market underperform. The fund achieved its goal of providing tax-exempt income, but at the cost of trailing its broader benchmark index. Alright, that's our breakdown of BNY Mellon California AMT-FREE municipal bond fund's latest filing. What's your take on this heavy California concentration, and what does it signal for investors? What are your thoughts on the performance of these different share classes? Drop your opinions in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and make sure to subscribe for more deep dives into corporate filings. And don't forget to join our Discord community linked in the description for more direct engagement and to connect with other finance enthusiasts. Thanks for watching, and we will see you next time on Corporate Filings. And don't forget to join our Discord community linked in the description for more direct engagement. And to connect with other finance enthusiasts, thanks for watching, and we will see you next time on Corporate Decoder.